Mohammed Afabhai, head APAC Trading Strategies at Citi as well, joins in. Mohammed, hi, morning. How surprised are you by Fed's decision of zero taper?
I think it's come as a big surprise to the market. I think most of the houses were predicting some form of taper of anywhere between $10 to $15 billion. And certainly after the comments from the Fed in May, the market was on very much a taper alert. And we saw the negative reactions from especially the emerging markets in relation to the impact of Fed taper. So certainly the economic numbers that had been coming in, at least over the summer, seemed to be more positive. The market had been reacting to them fairly well. But it seems that in the last few weeks, some of the numbers that were starting to come in were a little bit softer, and I think the Fed has reacted to those. The interesting thing is, though, that over the summer people were buying regardless of tapering expectations because they thought that the economy was recovering. And now there are some voices that are questioning whether the economy and earnings are going to be as good and what exactly it was, apart from the move in long-term rates, that has convinced the Fed to defer tapering for the time being.
Mohammed, of late emerging markets have rallied despite or against fundamental odds. Do you think in the short term emerging markets will continue to rally because of this big adjustment?
Yes, I think in the immediate short term, the emerging markets will rally back. It's interesting if you look at the share prices of where they are right now compared to where they were on May 22nd when Mr. Bernanke talked about tapering. Most of the indices are actually flat. So the U.S. equity market is flat to slightly higher. Markets in Hong Kong, Australia are pretty much flat, and Korea as well. But the markets that are still significantly down are the ones in the emerging markets. And if the tapering is not going to happen effectively, at least for now, effectively what it does, it buys these countries and these economies a little bit more time to put their house in order. I think the Fed is also cognizant of the fiscal debate that is going to be happening in the U.S. Next month. But I think the important point is that for the people who thought that the U.S. economy and U.S. fiscal and monetary policy is not important for emerging markets Asia, I think it's brought it very much back in focus, at least the events of the last few months have.
Mohammed, the big question for us guys is, what does the central bank do come tomorrow? Because we've got our very own RBI credit policy, the first from Raghuram Rajan. Zero taper by Fed, but we've been grappling with problems of our own. What does he do?
Yes, I think he's in a very tough spot. Mr. Rajan has been very much welcomed by the market. But I think there is still room for disappointment. Some of the IMF projections for where the fiscal deficit could get to are fairly scary from a market perspective. So I think that yes, Mr. Rajan can do a certain number of things on the monetary side, but really the fiscal side. And again, I come back to the issue of the 4 5s, the 5% fiscal deficit, the 5% trade deficit, 5% inflation and 5% GDP growth. Those remain the metrics for the reality of what is going on in the Indian economy. So I think that, yes, there may be a relief bounce, but it's probably, there's probably better value elsewhere. One thing that is interesting, though, is that if you look over the period since tapering, the H shares in China and the Nifty in India have performed exactly in line, i.e. there is no real difference in performance from point to point. And one of them had a credit squeeze in June, i.e. China, and then since then things have calmed down. And the other one is probably in the midst of a credit squeeze, and with probably deteriorating fundamentals and a much sharper growth slowdown. So for us, we continue to prefer China and Hong Kong over India, while remaining in a fairly bullish environment. In fact, I would probably say that myself personally am probably the most bullish that I have been on equities as an asset class overall, probably since late June and certainly since May.
Mohabbat, so for those who have missed the recent rally in emerging markets, should they wait it out, and as the year unwinds, do you think they would get better entry points, or now it's time to jump in?
I think that with the Fed doing what it's doing, every single dip is going to be used as a buying opportunity. I still think that there is a fair amount of cash that is sitting on the sidelines that was preparing for interest rate hikes. There was not interest rate hikes, but even higher bond yields, looking to take advantage of them. I think, although we're not talking about a rotation from bonds to equities, I think what you do see is that the inflow of new money is going to be towards the equity market. So unless there are good reasons as to why you should not be buying a particular country, and a lot of that is to do with deteriorating macro fundamentals and current account deficits, and the two countries that would probably be in focus more than anywhere else would be India and Indonesia, followed by Thailand. I think apart from that, a lot of these dips are going to be used as buying opportunities, especially in the cyclicals and the higher beta sectors.
So Mohammed, I mean, what's the recommendation then when it comes to, our India viewers? Do you think one should look at selling into the rally, which may last for at least, 1 or 2 days?
I think if you are domestically Indian based, I think it's very difficult to call the direction here. I think what my view remains fairly bearish on India. I have been taken by surprise by the ferocity and the power of the move back higher again. But the fundamentals continue to deteriorate. There's a lot of one-off events that can explain what has been happening in India in terms of the reason for the rally back. And also, if you look at the breadth of what has actually caused the rally, is actually very limited. So some of the names like HDFC, ICICI Bank, even Reliance, I think they're going to remain vulnerable. If you look at the effect of QE even overnight, what you're seeing is a rise in inflation. So again, more pressure on, rise in oil prices, more pressure on inflation, more pressure on the fiscal deficit. So I think just like in 2011, where you saw QE actually acting as a negative for the Indian equity market because it caused inflationary pressures, I think you'd probably be pretty much in the same picture again. So right. I'm not in any particular hurry to change the bearish view on India, especially when there's much better opportunities elsewhere across the region.
Okay, let me give you some data which may challenge your bearish view. The IP data was strong, monsoons are okay, and trade deficit also has improved.
Yes, well, if you look at the forward projections that we are seeing now, we're looking for higher oil prices, potentially higher food prices, certainly on the international arena. So I think the pressures are still going to be on the upside. Again, what I would do is I would highlight to you the things that actually move when there is an expansion of QE. And this time, although there's no expansion, there's certainly an expansion of the expectations of what is likely to happen. I think, if there is an opportunity which has been provided, then it provides the government to do a lot of repair on the fiscal side. Because one thing that we do know is for sure is that this tapering debate is not going to go away. At some point, it is going to come back. And I think what the government has had is a bit of a wake-up call about potentially what could happen if they don't get their house in order. So I think tomorrow what we could see is some tinkering around with rates and various other things. But I think again there'll be an RBI call to the government to try and get the fiscal house in order so that the Indian market, both bonds and equities, is not so vulnerable when the eventual Fed taper does come about.
Mohammed, it's really good chatting with you. Appreciate you taking the time out and speaking with us as always. Mohammed Appa Bhai from Citi.